Hello, the objective of the video of today is learn a little bit about the acquisition method and the 5 steps that we need to take in the evaluation process of a business combination. In the acquisition method, the first step requires to identify who is the acquiring company, who are going to be the shareholders that will lead the future of the company. This is important because we will distinguish between the acquiring company and the acquirees, and in the measurement process that we will see in other videos, you will see that the acquiring company will always maintain the accounting value and there will be no variations due to the business combination. In the second step, what we are going to see is when the acquisition takes place, when the profit and losses of the companies get together and all the incomes, cash flows belongs to the new company or the new structure. The third step means to evaluate how much we pay for the business combination. So after that, we will need to identify for what we pay that quantity. We will have to identify which assets and liabilities we are acquiring, and we will need to take decisions about the valuation process, whether we take the accounting value or the fair value. And finally, by comparing steps 3 and 4, we will obtain whether there is any difference or not. If there is a difference, we will see that we will call it either goodwill or negative goodwill. If you look to these processes in some accounting manuals, some of them you will see that are merging steps 3 and 5. So to go into a little bit of more detail about who is the acquiring company, we need to identify the company that acquires the control over the business or businesses acquired. So in graphic, we may have two companies that get together, and we will need to identify in economic terms, not that much in legal ones, who is going to lead the future. So for doing this, we will need to identify who holds the decision-making capacity. In the accounting plans, we have several rules that we can apply. The more general rule will be that the acquiring company is the one that pays a consideration for the business acquired. But there are other methods. One of the most commonly used and preferred is looking at the shareholders after the acquisition and identify who has the majority of the votes. Sometimes with the votes, we are not able to identify that somebody has the majority, 51%. And so we focus on the governing board. If we focus on the governing board, we will try to identify who has appointed the majority of the members. So for example, if we have a governing board with 7 members, the company or the shareholders that have appointed 4 of them will have the majority, and so the power after the business combination. If it's not possible to identify this within the governing board, we will look to the senior manager of the companies. In this case, because managers change more often, we will see who has appointed the majority of them, considering that they have been in the company for at least 2 years. These ones are the preferred modes to identify the acquiring company, starting for the boards, later the governing board, and finally the managers. But there are 2 additional ways to identify who is the acquiring company, who is the bigger one, because probably the bigger one will achieve more votes after the business combination, or who has paid a premium over the business that is being acquired. If we look to the acquisition date, from this date on, the assets and liabilities of the company or the business that is being acquired will change of ownership since that date. And if we look to incomes and expenditures and also to cash flows, it will be the starting date from which these incomes belong to the new structure. So it will be the key date for the accounting purposes. So for elaborating the new financial statements and for elaborating the new income statement. As an example, we have here the several dates of a merge agreement. When the contract was signed, the 15th of September, when the general meeting approved the merging processes, when the price was established, and when the price was paid. So we need to consider that for any merge, the key starting date will be at least when the merged project has been approved. So if you look at the soonest, the date of this business combination will be the 30th of September. But if we take into consideration the wording of the case, we will see that the price is set the 31st of October. So this will be also a key date for us, because as the prices changes, the real risk can be evaluated only at this date. So the soonest date will be after this consideration, the 31st of October. Another important thing is that as accounting is based on accruals and not on case based, we are not going to take into account the date of the payment. So we will forget everything about the 1st of January of the next year. The third step, we say how much we pay. This is the cost of the business combination. It's the fair value of all the elements that we used to pay. We will see through any merger and acquisition course that we can use many different things for this payment. The most traditional element to pay is the cash, but we can pay also with other things like a piece of land or equity instruments. So we will include all the assets that we give for this payment. The next thing we need to take into account is whether we assume any liability of the other company. So we will do an additional payment to the shareholders, or we will do or assume any other liability. If we have any expense related to this liability, they will need to consider as the rules that we will apply to any other one. So usually they will be included in the liability as or to obtain the effective interest rate. And finally, we can pay also with our own shares, shares that we bought previously on the market or shares that we have issued for this operation. If there is any expense related with issuing new shares, they will be considered as a reduction in the earnings or the reserves of the company. In addition to these three elements that we pay, considering that the business or the company that we have bought is perfect, that the profitability and the performance of the company is going to be the one that we negotiated, we need to consider that sometimes these promises get broken. So what we can establish to guarantee what we were promised is a contingent payment, what we call contingent consideration. And the formulation of these payments are set if profitability of the company reaches 5% during the next 5 years, we will pay an additional amount of something. This will allow that all the negotiations of the business combination are done in proper terms. So once we know what we have paid, the next step, as we said before, is for what? So the first thing we need to do is identify all the assets that goes with the business and all the liabilities that we will assume. Additionally, we will need to identify whether the company have some additional assets or liabilities that weren't in the financial statements, but that by applying the accounting rules need to be accounted for. And the next step, once we have identified all these assets and liabilities, is to value them. So we have a piece of land, which will be the value of this piece of land. And except in a few cases, our valuation process is going to be always the fair value. How much the market will pay for these assets. How much we have to pay to settle a liability. So we have how much we have paid, and we have one by one all the assets and liabilities that this business include. Sometimes, or in many cases, these values differ. So when we compare these two values, what we have as a result is the goodwill or negative goodwill. In this graph, we will see that if we pay 100,000 for a business, but the fair value of assets and liabilities one by one sum 90,000, we will have as a result a difference, a positive difference, and it's what we call the goodwill. The goodwill is an intangible asset, and it will be recognized within the assets of the new company, and it will be depreciated. By contrast, we can pay a lower quantity if we compare it with the fair value of the assets and liabilities. In this case, what we call or what we have is the negative goodwill. It will appear only once, and it will appear in the income statement as an income, as an exceptional income, reflecting that our negotiating capacity has been good enough to pay a lower value than the fair value of the assets and liabilities. Thank you for your attention, and I hope you have understood a little bit better what the steps of a business combination are.